Hey, good day, everyone. Welcome to our webinar. My name is Bert Salazar, and I'm going to be your host today. I'm excited to be with you, and it's the first webinar that we do in 2019, and we do webinars pretty much every other week. Obviously, we do a lot of podcasts, and we do webcasts, and we also do seminars where people come to listen to us and get educated and learn about tax planning and about retirement planning and so forth. Today's event is going to be on 4 ways to reduce your taxes in retirement. And that's a subject matter that I have been talking about for the last 30 years. I've been in the industry that long. But over the last 15 years or so, our practice and my firm has specialized in tax planning and tax-preferred retirement. And we do a lot of financial blueprints for our clients, and I'll share that with you toward the very end. By the way, this is going to be very, very informative for all of you that are going to be joining us, and I see that more and more of you are starting to join us. So we're going to get started in about 45 seconds or so. But again, I want to welcome you all, and I want to share with you that we're going to be providing you with a tremendous amount of information. But although information is very, very good for all of you, I am one person that always thinks that information without education always leads to failure. So what I intend to do tonight as I walk you through the time that we're going to spend together is I want to share with you information. But by the same token, I want to give you the analogy and I want to give you the education that comes behind it. Because at the end of the day, when you go on the internet to gather data, that's pretty much all you're doing. I get calls all the time from clients and people like yourselves that are joining us today, asking questions about tax planning, estate planning, investments. Obviously, we don't work in the stock market, so that's not something that we do. But they do have certain questions regarding taxation of investments and so forth. And they read a lot of information. They gather a lot of information. But at the end of the day, unless you truly know, how to review the information, make certain that the information is suitable to you, your business, and your family, there's a very high opportunity or probability that you're not going to be able to get what it is that you're trying to obtain just by going on the internet and gathering data. Now, tonight again, we're going to be talking about the 4 ways in which you can reduce your tax liabilities in retirement, and I'm going to share with you a lot of good information that I think you're going to be able to take with you. And then at the end of the webinar, I'm going to give you a tremendous opportunity to engage us on a one-on-one basis in order to answer any type of questions that you may have, and you're going to be able to do so without any cost to you whatsoever, at least for a 30-minute video conference that we can host. I hope all of you have your water together. If you have a cell phone, please turn it off. You may want to take some notes. It's important to do so because I'm going to cover some very critical information. And then once I go through this webinar, then feel free to reach out to me. I'll give you my personal information at the very, very end of this webinar. And then if you feel that it may be suitable for you to engage us and for us to obviously be able to work with you, because it's got to be a 2-way street, then obviously we can proceed accordingly. So with that being said, let me go ahead and share my screen with all of you. And then we'll get started right away. Great. So again, those of you that just joined us, welcome to our webinar. My name again is Bert Salazar, and I am the management and principal of my firm. And obviously we have a number of people that work with us, but I'm going to be your host tonight, and I'm going to try to make this as interesting as I possibly can, because at the end of the day, taxes is, or information on taxes or doing any tax planning is like trying to get a colonoscopy. Nobody wants it, but everybody needs it. So I'm going to try to make the information as palatable to you as I possibly can, but I think it's going to be very good, and I'm excited to be here. I want to thank you right off the bat for joining us, because obviously I know that you're taking a little bit of your time to join us, so hopefully I'm not going to let you down. I know I'm not going to let you down, and we're going to spend some good quality time together. So as you can see there, 4 ways to reduce your taxes in retirement. Again, Bert Salazar, and I'm going to be your host. One of the disclaimers I like to use with you is that I don't work for the IRS. I don't work for Social Security Administration. Now, I am a tax planner, so we do tax preparation in my firm, amongst other things that you're going to see in the next couple of minutes. And the examples that I'm going to be covering with you are hypothetical examples, but these are some of the examples that I have been able to do for many of my clients for the last several years. So I think you're going to be privy to some really interesting concepts that perhaps none of your advisors or none of your tax preparers have ever shared with you, but I'm going to go ahead and share that with you along those lines. So I hope you're ready. By the way, if you want to teach your kids about taxes, this is the best way to do it. I did it for many, many years. I think it worked out really well for my kids, but on the other hand, I put on like 25 pounds, which it took me a long time to be able to get rid of. So obviously that's the best way to teach our kids about taxes. Just take 30% of their ice cream, and hopefully they'll know exactly what taxes is all about. Taxation, obviously, one of the things that I share with all my clients is that taxation, there's a big difference between tax preparation and tax planning. Most of the clients that we engage for the first time have pretty much always done tax preparation. At the beginning of the year, they gather all their data, they send it to their accountant, they get together with the accountant, they figure out how much taxes they're going to have to pay, if any, or if they're going to get some kind of a refund, and life goes on from there on. What we do in our firm is totally different. It's tax planning, which means that it is a proactive approach, because when you do tax planning is totally different than tax preparation. Tax preparation, you're looking into the rear view mirror. Tax planning, you're looking into the rear view mirror to figure out what happened in the past, but you're also looking through the windshield in order to determine how to minimize taxes in the current year and for many, many years to come. So, that's something that you'll come to know from a business perspective. Now, like every firm in the marketplace, and although most firms in the marketplace do have vision and mission statements, but very few of them adhere to those statements, we in our firm, we do have a mission and vision statement. And obviously our number one goal is not to be all things to all people. We started doing that about 30 years ago, but obviously we found out that, we couldn't make everyone happy. So at the end of the day, we started to become very targeted. At some point in time in our business career, maybe 5 years into our business, we decided not to be all things to all people, but we decided to be all things to some people. So that worked out a little bit better. We had a little bit of a targeted approach as to the type of client that we wanted to engage based on the services that we would be able to provide. But even then, although we were just being all things to some people, we were still being too broad. So about 15 to 18 years ago, we decided to go back, take a look at our business plan, take a look at all the clients that we had engaged, for the previous 12 to 15 years, and we decided to make a paradigm shift. And the paradigm shift was that we wanted to exclusively work in the retirement arena. So our number one goal moving forward was to be some things to some people. And I think that's where you start to get into the specialty. Most of the advisors and most of the the tax preparers that we compete against, they have the ability to do a whole array of things. And we, as a firm, have the ability to do just about everything when it comes to tax planning and financial services, but we have decided to just specialize in just being some things to some people. Now, what does that look like? Well, because of the fact that we own 3 separate firms, and obviously Gables Tax Planning Group is the tax planning arm of our entire entity structure, we decided to just specialize in 3 things: to do tax planning, insurance planning, and certain, and I mean certain, investment plannings. And even when it comes to the insurance side of the house, we only do certain things that work very congruently with the tax planning that we do for the vast majority of our clients. Now, I think what you will find there is that the vast majority of the clients that come to see us for the first time or that engages in these types of scenarios come to us through our tax planning process. And the reason for that is even if they're employed today, their #1 goal is to minimize their tax liability every year. And if they're thinking about retirement and they're anywhere between 5 to 10 years away from retirement, then all of a sudden they start to think about other issues that may negatively impact what it is that they do every single day from a tax planning perspective. And then last but not least, those clients that are now entering retirement, their #1 in retirement is, to make certain that they can minimize their tax liability as much as possible. Now, our preferential goal is to meet clients that are anywhere between 5 to 10 years away from retirement. And normally we meet clients that are from 5 to 10 years away from retirement. Sometimes we meet clients that are 6 months to a year away from retirement, and many a times we meet other clients that are already in retirement. Obviously, the longer time that you have before retirement, the more planning that we can do on behalf of yourself, your family, and your business along those lines. So I just wanted to share some of the things that we do. And obviously, my daughter happens to be in the business, so we're a family business, and we've been around a long, long time, and we intend to be here for many, many years to come. Now, one of the major differential approaches that we have to the way that we do client and that we do our business and the way that we service our clients is that when we look at retirement planning, we look at retirement planning totally different than the majority of the competitors that we deal with in the industry. We look at retirement planning from a risk management perspective. And if you're able to manage the 4 risks that I'm going to share with you in the next few seconds, then you can say to yourself that you've done a tremendous job in preparation for retirement, and that there's going to be a very high probability that both you and your family are going to be well set from a retirement standpoint for the rest of your lives. Now, the first risk that we look at very closely as we start to do our tax planning blueprints with our clients is the risk of living too long. You see, Americans are living a long, long time today. Now, many, many years ago, what used to kill us is not only killing us, so people have a tendency to live a lot longer. As a matter of fact, if you're married filing jointly and you're healthy and you're a married couple at the age of 65 today, there's a very high probability that one of you is going to be alive at the age of 92. So all of the planning that we do for our clients take into consideration 3 decades of planning. I call those the go-go years, the slow-go years, and the no-go years. Now, when it comes to the risk of living too long, there are a lot of issues that you need to address, because at the end of the day, you don't want to run out of money before you run out of life. Because if you do, then the end of your life is not going to be a very good one, and that's something that we would try to avoid as much as we possibly can from a business perspective. The next risk that we address as part of the tax planning blueprint that we do is the risk of living with a disability. Yes, people are living a lot longer today. But because of the fact that people are living a lot longer today, they're more and more susceptible to having disabilities like long-term care and so forth. And long-term care is a major, major issue to deal with because it's impacting the vast majority of Americans today. As a matter of fact, if you have a husband and wife age 65 and they're fairly healthy today, there's a 75% probability that one of them, if not two of them, but at least one of them, is going to have a major long-term care issue to deal with before they finally pass away. The third risk that we address with our clients in the tax planning blueprints that we do is the risk of living with eroding factors. And for me, erosion is, whatever can take away from the betterment and the management of your money. So taxes, inflation, stock market volatility, interest rate volatility, propensity to consume, lawsuits, a lot of issues that people don't think through are issues that are going to be impacting you in the future. And then all of those issues are going to have a negative impact and a very detrimental impact on the outcome of your ability to sustain your standard of living for many, many years to come. And then last but not least, which would be the opposite of living too long, is the risk of dying too soon. And that would be, what would happen to you if you happen to have a premature death in the family? What if you're the first one to pass away? And you were thinking about living 20, 25, 30 years into the future, and you didn't wake up tomorrow morning. What kind of an impact is that going to have on your surviving spouse? What kind of an impact is that going to have on your family? What if your spouse is the first one to go? What financial decisions have you made along those lines? And then we cover all those areas, which would include estate planning, wills, trusts, income guarantees, Social Security replacement. So a lot of things have to come into play. But what I can share with you is that if you're able to address your retirement distribution planning from a risk management perspective, you're going to be in a much, much better position than anyone would be unless they do something along those lines. So that's something that obviously we do very heavily for each and every one of our clients on a regular basis. Now, if you had the ability to draw on a clean canvas what a proper retirement plan should look like, and I'm going to put on my glasses because as you get a little older, then you start to need some assistance from glasses and so forth. But, whenever I sit down with a client, the first question that I ask is, what do you think a retirement plan, a perfect retirement plan is comprised of? And then I get a lot of feedback from them. But because of all the feedback and all the years that I have been working with retirees in the marketplace, for me, a perfect retirement plan has to have the following features. Number one, it has to be able to provide guaranteed income. If it's not providing guaranteed income, it's not a perfect plan. Remember, when it comes to retirement, it's all about cash flow. And the more guaranteed cash flow that you can have, the better off you're going to be in retirement. Number two, it's got to be able to provide for longevity planning. It's not only getting guaranteed income, but if you only get it for a number of years, then what good is that to you or your family? So you have to have guaranteed income. The income has to be able to outlast you and your surviving spouse for at least one day. So that's something that's very critical because you don't want to run out of income before you run out of life. Number three, not only do you need guaranteed income and longevity of that income, but you also need to have inflation protection, meaning that that income is going to be increasing every single year in order for you to be able to maintain your standard of living in many, many years in retirement. By the way, just to give you an idea, if you need $75,000 in retirement today, 20 years from now, that $75,000 is only going to be able to purchase $41,000 worth of goods and services. So obviously you can see how your money is being eroded by inflation. And I'm not even talking about taxation or anything like that along those lines. Now, the next area would be a perfect retirement plan would be one in which taxes, your income, or at least the income that you're generating, is tax-free. And we'll talk a little bit about that in the next few minutes, but there's a very high probability that taxes are going to have to double in the future, or our country's going to be bankrupt. So if all of a sudden you got to pay double the taxes that you were paying prior to retirement, then that's actually eroding your retirement income coming to you and your family on a regular basis. So guaranteed income, the longevity of that income, inflation protected, tax-free income planning as part of the income that you're receiving. Long-term care hedging is very, very important, because you want to make certain that, you know, if you don't die in your sleep and you have a need for long-term care for, you know, 2, 3, 4, 5, 7, 10 years, that all of a sudden you're going to have some financial issues because of the fact that you didn't do proper long-term care protection, because now you have to invade more and more of your assets in order to cover the additional expenses. And then last but not least, that income that you're generating while you're alive needs to be able to be there and readily available upon your passing, so that income can continue to your loved ones, your surviving spouse, your children and grandchildren, if you choose to do so, for many, many years to come. Now, obviously, from a taxable standpoint, there's a fast approaching train that I'm going to be discussing with all of you, and I call that the tax train. And I call it the tax train because, you know, we're a tax planning firm, so a lot of the work that we do with our clients is to make certain that we can reduce their eroding factors as much as we possibly can. And if we can do so in a viable basis, then obviously we have done our job as a tax planning firm. So the taxes, obviously you can see there. By the way, you can pull this information from the internet, is the debt clock. And it's when you log into the internet, you can see it, and it's going every single second. So you can see there, I'm not going to go through all the numbers, but I just want to share a couple of numbers that are going to be very critical for all of you to understand. Because if you don't understand the problem, you're never going to find a solution. If you take a look at the top left-hand corner there, you see that our national debt is approaching $22 trillion. That's an enormous debt. We are actually at the highest debt that we have ever had in the history of our country. If you look a little bit, move over to the right, you see that the US government is generating just north of $3.3 trillion annually in revenues. But if you go to the left-hand side, right below the $21.8 trillion of national debt, notice that the spending, in other words, that's money that the US government is spending every single year, is actually $4.1 trillion. So we're bringing in 3.3 and we're spending 4.1. How long do you think we're going to be able to keep that up in our country? So our current federal deficit is at $846 billion. And my understanding is that from all the tax publications that I have read, that in 2019, our deficit for the first time in history is going to hit $1 trillion. That's an enormous amount of debt. Obviously, the only way that our government is going to be able to offset that debt is going to be by reducing benefits, by cutting the expenses, which I have never seen, a government that will do that. I mean, no Congress has been able to do that. There was a couple of times that back in the 90s we were able to do it, but by the same token, based on what we see today and what we foresee in the future, there's a very high probability that they're not going to be able to do that. So in order for them to offset the liabilities, they're going to have to raise taxes. And obviously there's going to be a deadline for taxes, which you will see in the next few minutes. Now, if that is a big issue, look at the very bottom of this slide. and that's going to be a critical one. If you look like in two columns down in the bottom, notice that the unfunded liabilities for the U.S. government is now over $116 trillion. What does that mean to you and I? Well, it basically means that the unfunded liabilities are all those promises that the U.S. government has made to its people that they don't have the money to pay for today. So Medicare, Medicaid, interest on the national debt, Medicare Part D, all of those things that the government has promised all of us that they're going to provide to us, they just don't have the money to be able to keep. So again, having the ability and taking the time to do tax planning is going to be more and more important to all of you on this webinar today than anything else that you can do in the future as you prepare for retirement. Now, obviously, in continuation of the fast approaching train, take a look at what we see there. I just talked to you a few seconds ago about this. The $115 trillion and counting, Social Security and Medicare. By the way, those two have the largest portion of that unfunded liabilities that you see there. Our national debt of $22 trillion. National debt, by the way, the national debt is increasing by $2.7 trillion $2.7 billion every single day. And our unfunded liabilities are actually increasing by $4 trillion every single year. Now, one of the questions that I get asked all the time is that people have a very difficult time understanding the difference between a million, a billion, and a trillion. So I normally ask a question that says, what's the impact of losing $1 million a day since the day that Jesus was born? So, we're in 2019, so he was born 2019 years ago, or let's say 2018 years ago. So if you were a business owner at that point in time and you lived that long, and you were such a bad business owner that you lost $1 million a day, every single day, for 365 days in a year, and also including leap years every 4 years and so forth, over a 2018 year period, you would have only lost $746 billion. You would not even be at $1 trillion of losses, $1 trillion of losses. Yet, our national debt is almost at $22 trillion. Our unfunded liabilities are now anywhere between $115 and $116 trillion. So the amount of of our debt in this country is enormous. So you can just figure, what's going to happen in the next 10 years when it comes to taxes and tax liability for each and every tax-paying American in the United States. Now, this is something that I hear often, that the top 1% needs to pay a fair share. No one has been able to tell me, and by the way, this is a partisan issue. This has nothing to do with Republicans or Democrats. This happens on both sides of the aisle. But whenever somebody says that the wealthy need to pay their fair share, my question is, well, what's your definition of fair share? And let me give you some numbers. The top 1% of income earners in the United States pay 40% of all the taxes. 44% of Americans pay no federal income taxes whatsoever. Top 10% of Americans, which are primarily the type of clients that I deal with, the top 10% of the clients that I deal with and the top 10% of all Americans in the United States pay 70% of all the taxes in the US. And then the bottom 50% of US taxpayers pay 3% or less. So the same way that people are talking about progressives, are talking about income inequalities, there's also tax inequality in our country, and it's something that we need to consider at some point in time in the future. The challenge is that if you're a politician, you don't want to talk about this, because if you want to start talking about reducing benefits like Social Security, Medicare, and so forth, that is such a hot potato that if you're running for office, you would never get promoted. So someone keeps kicking that can down the road. But what they fail to realize that sooner or later, if you borrow from Peter to pay Paul, that's all fine and well and good, but everything is well and good until Peter runs out of money. And then when Peter runs out of money, then what is Paul going to do? So obviously those are things that we need to consider. Another major issue that we need to consider before I get into, ways to reduce your tax liability in retirement, but you have to understand what the problem is and where the problem lies, because if you don't, then whatever I say to you tonight is going to go in one ear and out the other, because you don't think it's going to impact you, and it will impact you at some point in time in the future. Social Security challenges. Back in 1935, I don't know if you guys know this, but Social Security is a pay-as-you-go system. In other words, those of us that are working today are paying for those that are retired. Well, the challenge has been that, when Social Security was put together back in 1935, the ratio was 42-1. So for every retiree that we had back in 1935 in the US, there were 42 Americans working. So the world looked really, really good. Everything was going to be just perfect. But then things started to decay along those lines. In 1964, the ratio was down 10-1. 1985, 5-1. By the way, today the ratio is 3-1. We have, I was born in 1956. I'm 62 years of age. So that means that I'm part of the baby boom generation. There are 75 million baby boomers that were part of the baby boom generation between 1946 and 1964. 10,000 of us are retiring daily, and we'll be doing so for many, many years to come. So obviously, that is a major, major issue that Social Security is experiencing today, and the fact that people are living a lot longer than they ever did before. By the way, by the year 2026, which is just 8 years down the line, or actually 7 years now, because we're in 2019, the ratio is going to be 2-1. I don't know if you guys have heard of David Walker. David Walker was the Comptroller General for the United States, and he ran the U.S. The U.S. tax part of the government for 10 years, between 1998 and 2008. He was the Comptroller General, and he was the head of the GAO, which is the General Accountability Office, which is primarily the tax accountants for the government of the United States. And he basically said, as you can see there, that based on the current fiscal path that we were, and this was back in 2008, that we were at, in economic policy, future taxes would have to double or our country was going to go bankrupt. So that's a major, major statement from someone that is one of the most knowledgeable tax individuals that you can talk to in the United States of America today. Now, by the way, tax reduction carries no risk. So that brings me to the major point that what we need to do as Americans is, this is like David versus Goliath. And guess who David is? All of us are David, because we have no control of what the government is going to do in the future, but we do have control of what we can do with our assets today. Now, when you look at the U.S. tax history, just to follow through on this, if you look to the right, that's where we're at today. We're actually at the third lowest tax bracket history in the history of our country. Now, in the very beginning, in 1913, when the IRS came about, we're fairly low on the left-hand side of the slide there. And then during the Great Depression, taxes were reduced, to offset the issues with the Great Depression. But other than that period, we are living in the third lowest taxable bracket in the history of our country. By the way, back in 1944, 1945, the highest marginal tax bracket was 94% to anyone earning over $200,000. And then obviously, that was a major problem then. But although we're in the third lowest taxable bracket from a historical perspective, where is our debt today? It is at the highest level than it has ever been in the history of our country. So I can see that, if you had a crystal ball, I think you can you can see that train coming. And if you happen to be on the train track, then you better be able to do something and move out of the way, because otherwise the train is going to run you and run all of us and kill us all from a business perspective. Now, one of the type of planning that we do for our clients is what we call Social Security calculations. And the way that Social Security works, because whenever I engage and we engage clients in our firm, we immediately start thinking about Social Security distribution. And Social Security distribution is not only about, what is the optimum time for you to elect Social Security distribution, but also what is the optimum time in order for you to start taking Social Security distribution without creating a tax liability for you and your family. Think of it this way. If 100% of the income that you have coming to you in retirement comes from Social Security benefits, then you have to pay no federal income taxes on your Social Security benefits. The taxation of your Social Security benefits is not based on the taxes that you pay on Social Security, but it is on all the other income that you have coming to you every single year as you prepare to file your taxes, in addition to the Social Security benefit. So there's something called a provisional income calculation, and this is a calculation that the majority of advisors that all of you may have dealt with in the past have never shared with you. They have not shared this with you because A, number one, they don't know it, and B, they don't even know how to explain it to you. So here's how it works. In order for you to determine what percentage of your Social Security benefits is going to be taxed in retirement, those of you that are getting closer to retirement, you're going to take 50% of that Social Security benefit that you received in that given year. You're going to add your ordinary income, and that means that, if you retire or you're taking Social Security benefit, but you're working part-time, that W-2 income, that 1099 income that you have coming in for that year will be included. In addition to that, any distributions that you have made out of your 401ks and your IRAs, and that's also going to be included into the provisional income calculation. Any distribution that you have received in that given year from dividends and capital gains will also be added on to the calculation. And then last but not least, that income that is coming in from municipal bond funds. Now, some of my clients that own municipal bond funds say, well, wait a minute, Bert, time out. Municipal bond funds, if you do it the right way, they're coming into you as tax-free income. And the answer is yes. The income coming in from municipal bond funds, if you did it the right way, is free from any federal income taxes, free from any federal income taxes. But that distribution is added on to the provisional income calculation in order to determine what percentage of your Social Security benefits will be taxed in retirement. Now, most of you on this call, I am sure you have never heard anything like this, but this is something that you have to be very careful with, because if you don't do your due diligence and you have to pay taxes on your Social Security benefits, the probability that you're going to run out of money versus not paying taxes on your Social Security benefits is going to be anywhere between 5 and 8 years. In other words, if you don't pay taxes on your Social Security benefits, then your assets and the income that you generate from your assets is going to last 5 to 8 years longer than if you have to pay taxes on your Social Security benefit, because of the fact that you're going to have to invade more income and more principal in order to offset that tax liability. Now, just to give you an example, if you're filing single, if you're in retirement and you're a single person, if the provisional income calculation adds up to less than $25,000, then 100% of your Social Security benefits is tax-free to you. If it's between $25,000 and $34,000, then up to 50% of your Social Security benefits will be taxable to you. And if your income exceeds $34,000, then up to 85% of your Social Security benefits will be taxed in retirement. That's a big issue. Because if you do no planning whatsoever, then more than likely 85% of your Social Security benefits will be taxed. Now, if you're married filing jointly, then up to $32,000, you pay no taxes on Social Security benefits. Between $32,000 and $44,000, it would be 50%, and anything over $44,000, up to 85% of your Social Security benefits will be taxable. So you got to pay attention to the investments that you're making today and how they're going to be taxed in the future in order for you to make certain that you can mitigate those issues and concern as retirement approaches. Now, I'm going to give you a couple of quick examples. I'm not going to cover the entire example all the way through because the math is pretty boring, but no worries. This is something that we do. But let's say you have a couple that has, $20,000 in Social Security benefits, $40,000, they need to take money out of their IRA because they need to have an income of $60,000 a year in order to maintain their standard of living. So for provisional income calculation, we take 50% of the $20,000 of Social Security benefits, plus we add the $40,000 in IRA withdrawal. So although we have $60,000 of income coming into that couple, for tax purposes and provisional income calculation, we're going to factor $50,000. So as you can see there, if you go all the way across to the right, think of it this way. The total taxable benefit out of the $20,000 of Social Security benefit that this couple has coming to them, 55% or $11,000 of that $20,000 will be taxable. So that's a big issue. That means that 55%, more than 50% of those Social Security benefits are going to be taxable. And this could have been a family that perhaps, one person was taking Social Security benefits, the other person was not because he or she wanted to delay that benefit a little longer to get more money. But then again, by delaying that money, they were creating, by delaying that distribution of Social Security benefits, that we're creating additional issues and concerns like additional taxation. So let's take a look at the same couple, but now the second person decides to take the additional $20,000 of Social Security benefits. So now we have $40,000 of Social Security benefits, and since we only need $60,000 of income, then we only need to invade $20,000 of distribution from the IRA, in which we did $40,000 in the previous example. So now we still get to the $60,000 number. When you look at the bottom right-hand corner there, here's what you see. The taxable income, instead of $11,100 of the $20,000 being taxed, only $4,000 of the $40,000 of Social Security benefits is now susceptible to taxation, so that's at 10%. So although in this example, we were not able to get the client to a zero taxation of Social Security benefits, we were able to reduce that tax liability from 55% to 10%, because always remember that when it comes to retirement distribution planning, not all income is created equal. How does it look on the tax return? Well, you see there that in the first scenario, there's a tax liability of $2,559 of taxation. On the second scenario, there's no tax liability because that $4,000 that of Social Security benefits that was going to be taxed was offset by the standard deductions and credit that the couple received in the year that they filed their taxes. So now, look, the couple on the right has an extra, $200 a month in which to be able to spend, and $200 $200 of additional income to spend. Can be a car payment, can be, you know, a short vacation on a monthly basis, can be, you know, anything that additional savings, additional contributions, you know, to an IRA if you're continuing to work after you retire. So understanding how tax calculations work in retirement is apropos for everything that you do. Now, another issue to consider when it comes to tax distribution in retirement, where you need to be very careful, is if you have a lot of tax liability in retirement, and by the way, many other clients that I engage, the vast majority of their income in retirement is going to be taxable, then now there's a susceptibility that you may have to pay additional Medicare premiums in retirement when you get to the age of 65 because of the fact that you may have too much income coming into you based on that provisional income calculation that will now push that income to the next layer of taxation and increase your tax liability for your and not only retirement, but also for your Medicare premium. So again, taxes is something that you need to pay a lot of attention to. Now, under the IRS code, there are 4 vehicles that are federal income tax exempt. And when I say federal income tax exempt, these are vehicles that do not receive any taxation upon distribution from a federal income tax standpoint. There you have your municipal bond funds, you have your Roth 401ks, you have your Roth IRAs, and you have your 7702 plans, which are your cash value life insurance policies. Now, out of the 4, there are only 3 that are totally tax exempt, because my definition of something that is totally tax exempt, it would have to be federal income tax free, it would have to be estate income tax free, it would have to be capital gains and dividend income tax free, and last but not least, it would have to have no negative impact on Social Security benefits. So if you have a product that fit all of those 4 features and benefits, then you truly have a totally tax-exempt vehicle. And this is a situation municipal bonds don't fit that profile, because although they are received federal income tax-free, you may have to pay state income taxes if you live in a state that you have to pay state income taxes. Unless you purchase that municipal bond in the state that you reside, that is going to benefit that state or that municipality, you know, you may have to pay taxes. So if you live in California and you buy a Florida bond, you're not benefiting the state of California. So if you're reporting taxes in California, that income that you're going to receive from the state of Florida would be federal income tax-free, but you're going to be taxed at the state level for that. What if you buy a municipal bond fund, and all of a sudden the fund has grown in value? At the point in time of sale, if you have an increase in value from the time that you purchase to the time that you sell it, you're going to have to pay a capital gain. So from a tax-exempt standpoint, or a totally tax-exempt vehicle, municipal bond funds do not fit into that equation. Now, Roth IRAs, Roth 401ks, and 7702 plans are the only 3 vehicles under the IRS code that qualified for that. Now, obviously, I want to give you a tax planning reality, and I want to give you an example that I think is going to be critical. This is an actual case study that I want to share with all of you, and it is a case study that is an actual case. And by the way, we do many of these on a monthly basis, but this is an actual case. Obviously, I'm not giving you any names or any information, but this is an actual case that I want to cover with you so you can understand how tax planning, as opposed to tax preparation, can make a differential difference in your life, not only for you and your family, but also for your business. So husband and wife, age 50 today, they have a combined IRA amount of $600,000. So have they done fairly well financially? They have traditional mutual funds of $200,000, in which they're paying taxes every year on the growth of that money. They also The spouse, the husband, contributes 10% to a 401k at work. There is no match on that 401k. The wife contributes $6,500 to a traditional IRA. She does not have a 401k at her place of employment. They pay $6,000 annually for long-term care protection for the two of them, which actually that cost is not that bad because it could go much higher in the future. They also pay $3,000 annually for the two of them for term life insurance because they want to protect each other in case of premature death. And obviously, they're taking their standard deductions, mortgage deductions, qualified plan deductions, and they have teenagers at home and so forth. So they're taking all the deductions that the government and the IRS rules allows for them to take. Now, before I give you the outcome and how it is that we did the planning for these clients, I think it's important for you to understand that from a taxable standpoint, the IRS has three differential buckets. And when I say three differential buckets, it means that the assets inside of those buckets or the products or services inside of those buckets are taxed in a different way. So you have three different buckets. Obviously, bucket number one is what we call the taxable bucket. The bucket is the type of money that when you put it in, it's after tax. The money gets taxed every year. And then when you pull the money out, it's also taxable. Now, what are the products that fit that bucket? Most of them have them. You know, traditional mutual funds, CDs, money markets, savings accounts. So from a taxable standpoint, the taxable bucket is not very, very good. But from a liquidity standpoint, it is a very good bucket to have. So obviously you need to have money in that bucket. The key is how much money do you need to have based on your individual circumstances. The next bucket is a tax deferred bucket. Now that's a bucket that most of you probably understand because that's where you have your IRAs, your 401ks, your SEPs, your 403bs if you happen to be, you know, a private sector or public sector employee, your deferred compensation, your pensions may fit as well into the tax deferred bucket. And what it means is that the money that goes in is pre-tax. The money grows tax deferred. And then when you pull it out, you pay taxes on the whole thing. Again, from a taxable perspective, and even from a liquidity perspective, it's not a very good bucket to own. But by the same token, in order for you to be able to maximize the internal rate of return on the taxable bucket and the tax deferred bucket, you need to know exactly how much money you need to have in the tax deferred bucket as well as the taxable bucket in order for you to offset and mitigate some of the tax issues that we have already discussed in retirement. And then last but not least, you have there bucket number three, which is what I call the tax-free bucket. And that bucket, the money that goes in is after tax, similar to the taxable bucket. The money does grow tax deferred, like in the tax deferred bucket, but then when you pull the money out, you pull the money out tax-free. And again, the four products that go into that bucket would be, you know, your municipal bond funds, your Roth IRAs, your Roth 401ks, and your 7702 plans. We don't have time today to go into details into each and every one of the products in the buckets, but I thought it would be important for you to understand how they work. So what are some of the issues that I had to discuss with these clients that I presented to you just a couple of minutes ago? Number one, you know, I don't care that they have $600,000 of their IRA today at the age of 50. My question is, well, what is their IRA going to be worth 15 years from now at age 65 when they're ready for retirement? And if we took a 6% or an 8% rate of growth on those IRAs, they could be worth anywhere between 1.4 million and 1.9 million. That's a tremendous amount of money because, you know, once you get to the age of 70 and a half, and all of a sudden the IRS forces all of us to take mandatory distributions out of our IRAs and 401ks, the minimum distribution alone for this couple is going to be so high that it's going to force all other issues of Medicare premiums, taxation of Social Security, and incremental taxes in the future, regardless of whether taxes double or not in the future from a business perspective. So one of the things that we need to talk to them about, and that I did speak to them about, is how do we keep that IRA from growing too much, as opposed to, you know, not growing enough. The second issue is, well, you know, we have to have a conversation about Roth conversion suitability. You know, shifting an annual portion of the current IRAs and be able to do so to a Roth IRA, so by the time they retire in 15 years from now, there would not be any tax liability on that distribution. Obviously, because they're age 50, we want to avoid certain early distribution penalties, so we're using 7702 in order to be able to do that. The other conversation I had with these clients was, you know, the emergency fund and the opportunity fund, you know, shifting some of the assets so that way we don't keep any more, especially for this couple. Now, it doesn't mean that this is applicable to each and every one of you on this call, but for this particular couple that I worked with in this case is to keep only 6 months of expenses at time of retirement. So, and then last but not least, the 401k contributions, because we're compounding the problem. We already have 600,000 in the tax deferred bucket, and we're adding additional monies every single year. So we may be able to either try to use a Roth feature on the 401k or stop the contributions to the 401k altogether because they're not getting a match to begin with. Now, what are some of the issues, the other issues that we address and that we needed to address is, well, is there a way that we can recapture? In other words, can we recapture the long-term care and the term life insurance premiums that this couple was paying every single year? I think for long-term care was $6,000 a year. And then for term life insurance was $3,000 a year. If we're able to do proper planning for our clients, can we have our cake and eat it too? Can we provide excellent tax benefits, excellent retirement distribution planning for our clients, and be able to recapture that income that is being paid, or that premium that is being paid toward long-term care and life insurance? And then obviously, provisional income calculation. When we did the provisional income calculation for these clients, we were able to identify 57 we could do for these clients in order to get them ready 15 years from now to have an optimum rate of distribution in their retirement plan and be in a different position altogether than before they started to work with us. But because of the fact that we need to pay taxes on those $57,000 of distribution based on the tax planning that I did for the clients, then the net available income for distribution was just north of 39,000, almost 40,000, 39.9 thousand dollars. And by the for every individual, every couple that we work with, every person that we work with, the numbers may be totally different. But in this scenario, we started to fund a Roth IRA with $6,500. We funded a Roth 401k with $12,500. We funded a 7702 plan with $20,900. We were able to maximize at age 65. We're going to be able to maximize standard deductions, which will approximate $30,000 a year. We were able to receive Social Security benefit, and we were able to receive that Social Security benefits with no tax liability whatsoever because of the 401k net present value calculations that we did for these clients starting at age 50. And by the way, I started working with these clients about 3 years ago. So we do an update every single year, but because of the net present calculation that we've done for the clients, we're well on our way to make certain that we can provide the benefits to this couple that they would not have been able to obtain in any other way, shape, or form. So where are we from this perspective? Well, just take a look at it right there. At time of retirement, Any income coming out of their Roth IRA is totally tax-free, no impact whatsoever. Income coming out of the 7702 plan, totally tax-free. Income coming out of their traditional IRA. Remember I said in the tax-deferred bucket that the money goes in pre-tax, the money grows tax-deferred, but then when you pull the money out, you got to pay taxes on the whole thing. Well, that is true unless you do proper tax planning. Because if you do proper tax planning, then that income that we have already forecasted and did our calculations on to be pulled out starting at age 65 will be just sufficient income to meet the standard deduction. So we're actually having an offsetting approach in which the taxes that would have been paid on that tax distribution or the income distribution from the IRA is now tax preferred because we were able to offset it with the standard deductions at that point in time. And then obviously the Social Security income for our clients was totally free from income tax. So we had 0 on the Roth, 0 on the 7702 plan, 0 on the traditional IRA, and 0 on the Social Security income. So these clients actually, when they do file their taxes, they even qualify for Medicaid and food stamps if they wanted to. Not that we would ask them to do so, but because of the tax planning that they have done, and by the way, if you're going to be in the best possible tax planning in retirement, or tax bracket, it should be the 0% tax bracket like we're able to get these clients to, because even if taxes double in the future, 2 times 0, still 0. So hopefully you can appreciate the type of work that it takes. Now, it's not easy to do. You have to do a lot of calculations. You have to do a lot of tax planning every single year and tax forward planning, but this is something that can be done. Now, what were the outcomes we were able to accomplish for these clients? Well, take a look at this. If the clients stayed the course and taxes stay the same, in other words, say they visited with me, they said, Bert, great job, but you know what? We're going to stay the course, and taxes do not double or do not go up in the future, then these clients actually would generate almost $4 million in retirement income. The income would last, based on the inflation rate, 20 years, and income would last to age 87. Okay, you know, we have a little bit of a problem because, you know, they're not really hitting that third decade, but at least they have a lot of income. They could reduce, you know, their expenses a little bit, but they have almost $4 million of income, and income lasts to age 87. But if they stay the course and they stay the same, and income and taxes double in the future, then now their income goes from almost 4 million to 820,000 in 20 years, and income goes away at age 81. So now Houston, we have a problem. More than likely in this situation, the clients are going to run out of money before they run out of life. But if they do the tax planning that we do, if they engage us in having a customized tax planning blueprint, and we're able to accomplish what I shared with you just a few minutes ago, then this is the outcome for the clients. Clients can choose our planning straddles. They're going to be able to generate $5.2 million in income in retirement in 20 years. Income is going to last for a lifetime. So in the first 20 years, they have already offset at that 3.9 income in the best case scenario that they could have come up with. And again, as I said, they would qualify for Medicare and Medicaid and food stamps along those lines. So having the power to do a proper tax planning blueprint is critical for each and every one of you on this call. Now, as we approach the end of the call, I did tell you at the very beginning that I was going to give you the opportunity to have probably the best offer that you can enjoy from a tax planning perspective. And then the big question to all of you is, if you enjoy what you have seen tonight, and if you feel that what I have shared with you today can benefit you and your family and your business of future, then, you know, the question is, how would you like to work with me and work with us and be able to create a customized tax planning blueprint? Now, one of the things that I like to share, because I'm pretty straightforward, in the way that we run our business. We don't put any type of pressure with our clients because of the fact that, we can only generate a number of clients per year due to all the work that we do in trying to do tax planning for our clients. So I want to walk you through what our first meeting process would look like. Number one, it would be a meet and greet. By the way, many of the clients that we engage today, we do so over the internet. So we host video conferences where we can see each other. We can also host a conference call, or we can do a one-on-one meeting. So that would be okay. It would be fine. If you happen to be in Coral Gables, Florida, and you want to come to our offices, you have the ability to do so. But the vast majority of my clients nowadays do visit with us on a video conference basis. Then, what's going to happen? Well, obviously, we're going to have a good discussion. And what will I learn? Obviously, you're going to learn a lot because we're going to share a lot of ideas. I'm going to provide you with certain benefits, and and we're also we're going to try to find out together if having a customized tax planning blueprint may be suitable for you and your family. How long will it take? Usually it takes about 30 minutes. So I normally host a 30-minute video conference because I want to listen to everything that you may have to say. What's keeping you awake at night from a taxable or retirement perspective. Sometimes we go over 30 minutes, maybe 40, 45 minutes, but that would be entirely up to you. Question that I get is, what should I bring or have available? Actually, nothing. We just need to have a conversation. And the next question that I get asked is, well, will you try to sell me anything? Absolutely not. There's nothing I can sell you because I don't know anything about you, your family, or your business. So this is going to be a meet and greet. We're going to get to know each other. We're going to try to figure out, number one, whether we like each other or not. Number two, will the products and services that I can provide be suitable for you and your family? Number three, would you be a suitable candidate to be part of our Platinum group from a client perspective? Some of the other things that happen in our first meeting. How will it feel when it's all over? Well, hopefully you're going to feel a lot better. You're going to feel a lot more educated, though. I can guarantee you that. Where will we do it? As I said early on, we can do it anywhere. Most of the time it's a video call, so it makes it a lot easier for me and makes it a lot easier for you. What will the next steps be after this first meeting? Well, it depends. Sometimes it makes sense to move forward. Sometimes it doesn't. Sometimes it might even make sense to move forward, but not right now, maybe 3 months, 6 months down the line, maybe a year down the line, so we can always keep in touch. But by the same token, we're going to make that decision together. Now, there are 4 questions that if you engage us in this exercise, there are 4 questions, so you got to be ready to answer, which I will give you now. And the first question is going to be, what plans have you done to triple your income in retirement? And you're going to have to. So the one question that I'm going to ask you right off the bat is, what have you done up until today and what type of plans have you done to triple your income in retirement because of all the eroding factors and the tax planning issues that we have already discussed? Question number 2, what would happen to your financial plan if the market dropped 45%, as it did in 2003 and 2008, except that now you're getting closer and closer to retirement? What would happen? How would you feel about that? What kind of an impact would that have on you and your family? Question number 3, what have you done to protect your retirement assets from stock market volatility and interest rate volatility? That is a major, major issue in retirement, because the sequencing of returns is going to play such a detrimental role in your financial life upon retirement distribution that you have to have a plan in place in which you can create guaranteed income and you can protect yourself, your family, and your business from any stock market volatility or interest rate volatility along those lines. And then last but not least, what plans have you and your family done in dealing with, remember I talked in the very beginning, living with a disability, like living with Alzheimer's, Parkinson's, and some of those issues that are so critical, strokes for all of us. So those are the 4 major questions that we will be discussing in our first meeting, along with some of the other things that you may want to share along those lines. Our first meeting process obviously is something to look forward to. You're going to have a chance to talk to us, and I'm going to listen. I'm going to listen quite a bit. You will learn some new ideas and that you probably didn't know. And these are what I have covered today are just a few ideas. We have lots of ideas that we can share with you at some point in time in the future. You're going to get us to engage us personally and feel the way that we do our business and see if this is suitable for you. You will get to, you will get something of valuable. Because even if we decide not to move forward, then I will be giving you a white paper that I wrote. I just updated the white paper under the new tax law that is going to help you minimize your tax liabilities in retirement. So it's going to be a win-win for you and your family as well. And then hopefully you're going to have, and I know you will have, a tremendous experience just by visiting with us, whether we do business in the future or not. Now, the same way that I tell you, I would love to be able to engage you for a 30-minute video conference at no cost or obligation to you. I can also tell you that we should work together. If you're already satisfied with your taxes, if your CPA can do tax forward planning and tax planning, then perhaps we don't need to, to get together and visit. If you already have a safe retirement plan and it's already fail-safe, if you already have a retirement plan that you're comfortable with, after going through this webinar, then probably we don't need to go any further. If I'm more interested in your success than you are, then we're definitely not going to go forward, because this is an interactive process. We want our clients to be engaged. I do quarterly reviews with all my clients, so we better like each other, because otherwise this is not going to work. And then obviously, if you happen to have a family member in the business, and most of the time you may want to do business with them, so it's not going to work with us. Now, we do feel that if we should work together if, number one, you want to minimize your taxes and you want to maximize your Social Security benefits. If you want to create a fail-safe retirement plan because now you feel uncomfortable as to what you've done up until now, sometimes you may want to even us to audit your current retirement plan, and we'll be more than happy to do that for you. If you want to create a comprehensive retirement blueprint, and last but not least, if you're concerned about your retirement affairs, and that would include a number of different issues that very, very few people understand. So my call to action is, take me up on it, because at the end of the day, the definition of insanity is doing the same thing over and over again and expecting a different result. So that's something that's important. Give us a call. Let's get into a video conference. Let's discuss the viability of doing a customized tax planning blueprint. You will have 30 to 45 minutes in which we're going to be sharing a lot of ideas. There's no cost, no obligation in order for you to do that. If at the end of the day it doesn't work, then at least you were able to gather a tremendous amount of information, plus the white paper that I'm going to be sharing with you. So here is the link. Schedule a 30-minute video conference with me. If you actually click on that link right now, it will take you directly to my calendar. And then you can pick a time and a date that's going to be available. And then from there, I'll get notified. And then we'll have a preparation. And then we'll meet on that given time and date without any problem whatsoever. You can also call me. You can call us at area code 786-766-1042. Again, 786-766-1042. Or if you feel more comfortable, sending me an email because you may have some additional questions prior to scheduling that 30-minute video conference. Feel free to do so. You can send it to me at Bert, B-E-R-T, at GablesTaxGroup.com. You can always visit our website, our www.GablesTPG.com. So again, that's a great way. I'm going to go ahead and stop the sharing. I want to thank you all for for attending this webinar tonight. Hopefully I didn't take a lot of your time, but at the end of the day, this is all about your tax planning and your retirement life. So having the ability to go through this and identify some of the issues and concerns that are going to be impacting you, your family, and your business in the future is a time well worth taking. So I want to leave you with one final thought. My goal and that of my firm is always to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. Again, thank you so much for giving me a little bit of your time today, and we'll talk again soon, and hopefully we'll get to have a video conference and we'll take it from there. Take care. Bye-bye.